Hey, and welcome to another video here at Fiscal Voyage. I'm Felix, and we're going to do a 5-minute stock analysis on Enterprise Products Partners. This was suggested by Barry. Barry, thank you for watching previous video and commenting and letting me know you would like to see a stock analysis of EPD, Enterprise Products Partners. So let's start. It's going to be a 5-minute stock analysis to determine if the company is a buy, hold, or sell right now. Okay, here's the 5-minute stock analysis on Enterprise Products Partners. You can find it in the New York Stock Exchange as EPD. The company is a American midstream natural gas and crude oil pipeline company headquartered in Houston, Texas. Basically, think of it as a toll for transporting natural gas and crude oil. It's a master limited partners, MLP, so you have to use the K1 for tax purposes when you decide to sell it at a gain or loss. Let's look at the fundamentals. Revenue grew at a compound rate of 4.07% from 2009 to 2018. In that same time period, net income grew at a rate of 16.80%, which is outstanding. S&P has a credit rating of BBB plus, which is good, investment grade. Operating income in this 2009 to 2018 time frame was 11.68%. However, operating cash flow growth was 7.68%. This is because in 2009 they had an anomaly, which was higher operating cash flow than normal. However, when analyzing an MLP, such as enterprise products, we need to look at operating cash flow, not the adjusted earnings. However, revenue in the past 5 years has a negative 6.5% growth rate. But in that same time period, net income grew at 10.61%. So net income is growing at a great double-digit rate. And the past 5 year operating cash flow has a 5-year growth average of 7.58%. That's slowing down, but we'll see in the next few slides. We continue with the fundamentals for fiscal year 2018. They had an operating cash flow earnings report of $2.84, net margin at 11.42%, return on equity 17.98%, forgot the percent sign there, debt to cap at 49%. They currently have a great yield at 6.11%, which is great. It's actually much higher than the 5-year average, which was 5.93%. And they have a real good low payout ratio of 60.4%. So it looks like they could continue growing the dividends. The fact that they have a high current yield, and they've been growing dividends for 20 consecutive years. They tend to grow dividends every quarter, a few percentage point. So year over year, the dividend growth has slowed down at 2.31% compared to the 5-year dividend growth average of 4.18. So they kind of keep up with inflation or a little higher, but the current yield is very tempting for income-driven investors. Future outlook: analysts expect for fiscal year 19 for operating cash flow coming at $3, and in 2020 $3.15. So that is growing. So that's what I like to see, because when this grows, they could continue paying dividends and growing dividends at that. And analysts expect a compound annual growth rate of 4.5% for the next 3 years. So earnings is projected to grow. And my dividend drill return model projected total return at 11.7%, which is great, because I like to see companies at 9% or higher projected return. So that's good there. Currently, the company has a PE of 13.7 compared to the forward PE of 12.87 and the 5-year average of 19. So based on this, it looks like the company is undervalued with the PE matrix. If we look at the fast graph, the monthly closing price is the black line, the blue line is the normal PE, and the orange is the earnings with a multiple of 15. Looking at this, I would use the blue line, the normal PE, as my valuation point. So it looks like the company is undervalued based on this. So if we look at the next slide, the fair value price, section here. CFRA has a price target of $34, Morningstar at 35.50. The fast graph using a normal PE at $40.94, Yahoo at 34, and my dividend discount model analysis at $30. Averaging out to 5, we get a price of $35.19, and currently the company is going for $28.64. So it's undervalued by almost 23%, which is great. So with that, I have a buy recommendation for EDP, Enterprise Partners. So the reason for this is in the last year or two, MLPs has been hit hard. For example, ET, EQM, to name a few. But that gives us a great buying opportunity. So I love the dividend history of the company, 20 years of growth. Operating cash flow is continuing to grow and projected to grow at a nice steady rate. High dividend yield of over 6% and an expected return of over 11%. So this is great. So I see this company as a buy at current prices. So with that, if you have a company that you would like me to do next, please leave the name of the company and the ticker symbol. Thank you for watching, and if you find this video informative, please hit that like button and subscribe to my channel for more videos like this. And thank you for watching, and you can find my portfolio. There's a link in the description below. So thanks again, guys, and have a great one.